Buddy, this is Paul Hitchcock with Barth Calderon. Welcome to Wealth Protector TV. This is our channel at the firm to get valuable insight out to our audience. And at Barth Calderon, we are an asset protection, estate planning, business planning firm, and we're helping people across the country. And I'm really excited to have our guest on today, Paul Rafelson, who is a top attorney helping Amazon sellers. Paul, welcome.
Thank you so much. Good to see you.
Yeah,
Good to be on with you.
yeah,
So
yeah. Fired up. I
exciting
mean, you,
times.
yeah, you
Yes.
and I were talking a lot offline. I want to tell before we jump into your discussion, Paul, is for anybody that has questions on any of our live shows or any of the content going on here, you can text guard assets to that phone number on the screen there, and you can find a time to get some complimentary input on anything that we're talking about here. We'll get you connected to Paul or myself. So with that, Paul, for those who don't know you, you're knee deep in Amazon, working with sellers, a lot of M&A. So I thought we'd start with what's going on with the whole Amazon world these days, and then let's get into the M&A that you're seeing and what you're actually doing.
Yeah, it's an interesting time in Amazon world. I mean, you've had, the pandemic was actually obviously quite an interesting time for Amazon sellers. It was obviously as more people shopped online, people saw, a crazy sales growth. We've also seen probably the most interesting thing is the antitrust investigation into Amazon, which we were a part. I mean, we were certainly a part of, as we certainly represent through this nonprofit that I sort of do on the side as a volunteer. We try to represent the voice of the Amazon seller at a political front. We've
Right.
been very busy there and following the antitrust movement quite closely and trying to interpret what the moves are, what's going on. But meanwhile, people are continuing to join Amazon left and right. And then, as you said, we'll get into more. There's this sort of consolidator, we call them aggregator space, where there's these well-funded companies that are just buying Amazon brands left and right. So it's really, what a time to be an Amazon brand is like right now. The market it's insane. The demand is unlimited in terms of who these companies will acquire, and it's made us as a law firm extremely busy. And so yeah, so where should we dig in first? Where should we bite into first?
Yeah, well, I mean, a question I have is, I guess the M&A activity that you're seeing, and why now? I mean, why are these business being bought right now?
So it's interesting. The story goes back to the most famous one of these companies is a company called Thrasio, Thrasio, and they are out of Boston. And years ago, they were buying Amazon businesses. They were kind of you'd see them at the Amazon shows, and they'd have a booth. And they, we'll buy your Amazon brand, and they were paying 2.5 to 3x multiples on seller earnings, profit, um, and it was going really well, and suddenly people started to take notice, and a lot of investors started to take notice. But the idea is, look, it's a couple things. One, there's something algorithmic about Amazon that these buyers have kind of figured out that they can take an Amazon brand that's maybe it's making 500,000, $600,000 in profit, and with the right sort of adjustments to how it's run, investments in inventory, um, and things like that, PPC marketing, which is pay per click ads. They can see within a few months they can see 30% growth, and within a year they can see sometimes double growth.
Really?
So in other words, they can really take the brand. They sort of, and they really do describe it as sort of a formulaic way. Like it's almost like an assembly line. I say, imagine like you ever seen those that like the B-roll footage of like the Ford Motor Company plant where you got the door guy, you got the window guy, you got
Yeah,
and they sort
yeah.
of take an Amazon brand through that process, right? And what comes out, within a year, so they claim is, a much more profitable growing brand. And they're building these portfolios of these brands. Plus, you also have the economies of scale, right? You've got one company managing a portfolio of, hundreds of brands that they've acquired, so you've got the economies of scale there, consolidation among sourcing. There's just all sorts of efficiencies. And then what you also have is now you're taking, a company that might be worth 2 or 3 or 4, but you've put them all together and now you're 20, 30, 40x, like the multiple just comes up. So it's very lucrative. And, Thrasio sort of described themselves as sort of saying, we imagine ourselves, I was in a chat with them, listening in, and one of their reps said, we sort of envision ourselves as like what Procter and Gamble would be if it started, in the 21st century, if it started today, where that's our goal. And people took notice, right? So then you got all these private equity investors coming in, and then there's funding, other competitors. You have companies like Boosted, Goja, these names that, Berlin Brands Group, which I'll get back to in a second because something crazy happened there yesterday. Razor Group, and I can keep going on. There's like literally 100 of them. So now, if you're an Amazon seller, you can literally just take your brand to market. You don't really need extensive brokering. Like, it's not like selling a local business where you have to find that special buyer. You literally have 100 people you can email and they're going to be interested in your brand if it's half decent, right? If you're making.
Are they taking businesses that small, Paul? Like you have 500,000
Oh
revenue?
yeah.
Yeah, they
Oh yeah.
are.
We've done deals as small as we've done under 1 million deals, which were big more like a year and a half ago when there weren't as many. Like in the last year, this has blown up. There's like like a year and a half ago, there was probably Thrasio, Goja, 1 or 2 from Israel. There weren't a lot. In the last year, there was like 75. I mean, there's just they're from all over the world, and they're just snapping up Amazon brands left and right. And yeah, they will buy now. The bigger ones, the more established ones, will not like they used to take the smaller ones, but there's all these new ones coming online and they're trying to get their sea legs together and how they're going to do this. So they'll buy the ones that are doing, they'll buy ones that'll do 200,000 profit a year, 175, pay like a nice 3.5x multiple that's under 1 million, and they'll do those deals. So we see the gamut. I mean, we've seen 100 million, we've seen under 1 million. We've seen the gamut of those deals. And this one company that I'll mention, just because this just happened yesterday, Berlin Brands.
Yeah.
Thrasio has already hit, the quote unquote unicorn status of having that, above $1 billion valuation. I think they're close to two something at this point.
Wow.
And there's an expectation that they're going to go public through a SPAC. The rumors, Churchill SPAC, that there's a rumor that that's the, who knows? I don't know. But that's been the sort of the rumble. When you go to the Amazon shows, that's what you hear, and I think it's been reported in the news. But this other one, Berlin Brands, out of Germany. There's quite a few of these guys out of Germany. These companies out of Germany. They just got what I think it was like. They just hit their unicorn status after Bain Capital, I think, invested like 300 million or 275. Just put 300, but Bain Capital, right?
Yeah, right.
The
Big
Bain
name.
Capital,
Big name. Yeah.
Mitt Romney, right?
Yeah, Mitt
Remember,
Romney's boy. Yeah.
right. So they just put 300 million or close to that, something like that, and with another, I think, $700 credit facility on top of that to lend, for debt. Google it, you'll get the right numbers. But point is, Bain Capital is now in the Amazon business, right? Like this isn't going anywhere in terms of like the demand just seems insatiable.
But
So
Paul, but with all the stuff that's going on against Amazon, the antitrust stuff, and then the tightening up of certain rules and regulations on Amazon. I mean, you've read that Amazon competes with third-party sellers. I mean, is it risky to be on Amazon these days with a business because you get shut down at any time? And how has that landscape changed?
well, Paul, I think you hit the nail on the head for why people want to sell. I mean, when I work with these businesses, you ask them why are you doing this? They're just like it's like being at the craps table and taking your chips out, right? Like at some
Right,
point,
right.
before the 7, right? You want to take your you want to take your chips off. So and that's how they feel, right? It's like our clients have been sort of living in a life of anxiety and distress, yet they've been very profitable. They've been
Right.
building amazing brands, but they see this opportunity. Wow, I can get 4x for my brand. I'm making 700 grand a year. I can just walk away with $3 million, take all these chips off the table,
Done.
sleep at night again for the first time in 4 or
Yeah.
5 years since I
Yeah.
started this thing, and then maybe do it again, right? Take
Right.
another from that cash out. I'll take 50 grand and build a new brand, see how that goes, and maybe I'll do it. So we have this sort of saying in our firm. We say it's like launch. We help our clients launch, grow, exit, repeat, because that's what they do. I mean, they just like It's really fascinating. So the market's nuts. And I think, when you have, and that's the other side, it's like when you have Amazon who can unilaterally destroy, they actually recently did this to like $1 billion seller in China, which was a little scary, but the push of a button destroy business. I think, it's kind of cool to see a company like Bain Capital getting into the space, because, if somebody's going to push back against Amazon, it's good to have
Yeah,
Bain Capital
yeah.
on. It's almost like you have Bain Capital sort of on the seller side in some respect, and you've got these bigger players. And I think that this consolidation does play a little bit into where the antitrust issues are, because there are some antitrust issues that we've been vocal about trying to address, because there are some changes afoot with Amazon that we're afraid of. And so again, more reason to sell and get out. Let the bigger companies, let the billion-dollar companies deal with these brands. And what does that mean in the future? Like, will there be an Amazon to launch, and sort of the great equalizer where everybody has the same opportunity to make a great living? Will that continue in the near future? I don't know. That to me is the uncertainty. I
Really,
don't
really. I
think.
mean, why
Yeah.
why would that stop? I mean, why would it stop? Because Amazon would just be the main player there, or I don't.
Well, not Amazon, but you're going to have these you're going to have these consolidator
Oh,
aggregator
oh,
companies,
gotcha.
right? So,
Okay.
like, I mean, if you were making $300,000 a year as the 23rd best avocado slicer on Amazon, right? But now you've got, a $1 billion company that is dominating avocado slicers. I don't know. Is there a market? That's the one
Oh,
thing. The
right,
other
right,
thing
right,
is
right.
and you've got, again, quite a lot of these, right? If Bain Capital's company, is dominant in the avocado slicer space, I'm not sure the market is as open to new entrants as it used to be, right? Like, they're
Hmm.
backing them up. But the other thing is this: with the antitrust issues, um, this takes a lot to explain, so I'm going to try to do this very simply. Um, all the antitrust legislation that's out there, there's been a bunch of bills introduced, right? Jay Appel most famously breaking up Amazon. You got Cicilline, another way, sort of kind of calling for the breakup of Amazon. And these bills are sort of designed to force the breakup by saying, if you are a seller on a platform, you cannot own the platform, right? You can't own the platform that you sell on if if your platform is this big, super big, right? So very, targeted towards the Amazon
Right.
scenario. Well, here's the thing: Amazon has been very, is obviously opposed to these bills, and I'm not sure these bills are going to actually pass. It's kind of not looking great, but the fact that they're out there puts Amazon in defense mode. But here's the thing: Amazon. If I'm Amazon's lawyers, if I'm on their legal team, and I get this from, I'm looking at these bills, I'm saying, wow, these bills really target online platforms. But Amazon can just say, wait a minute, we're not a platform, we're a store, right? We're a store. Amazon sellers are suppliers. And because your bill doesn't break up like Costco or Target, it really doesn't apply to us. So, and I know that sounds crazy, but if you actually listen to Amazon's antitrust testimony, like I said, we were very involved, and you listen to their messaging over the last 2 years, Amazon, prior to 2017, 2019, they would never in a million years admit that they're a store. They'd always say the opposite, because they needed to get out of sales tax. They didn't want to be liable when
Oh,
somebody got
right,
hurt, right? They
right.
never wanted to be the store. They didn't want strict liability. They didn't want to be liable for the sales tax. Well, the sales tax issue is dead. It's over. It's all, Amazon's doing it now anyway. So that the prospective sales tax problems with Amazon, that's a non-issue. With the personal injury, I mean, there have been two cases in California, one in Pennsylvania, basically holding Amazon liable for injuries caused by products sold by 3Ps. So it's sort of game over there too. Like, they're accepting the fact that they may be liable right now.
Interesting.
So really, they have no reason not to be the store. And by establishing themselves as a store and saying, hey, we're not a flea market, we're just a store like any other store, they're kind of saying, well, these bills don't really apply to us. So, I mean, I see Amazon messaging and staging for the legal battle for whether or not these bills pass, or the government looks for other ways. Now, in order to convince the world that you're a store, you may actually have to consolidate who can sell. You may not be able to let everybody sell on your platform. You may not have a marketplace. What you may do is you may have your sellers selling to you on consignment, because obviously Amazon couldn't afford to buy and even Amazon itself really can't afford to
Right,
buy the inventory of all of its 3P sellers. But it could
right, right,
continue to just offer it on a consignment basis,
right.
which would be comparable to what the fulfillment by Amazon model is today. So they just sort of relabel what they're doing, calling it a store versus a consignment. And let me
But
explain
but
to you
how?
one.
Let me ask you a quick question on that. How is that different from like Walmart.com? I mean, Walmart.com's got a, they're selling online. They got the physical store. Amazon's got physical stores now, I think, in a lot of places. So, is the difference that what? I mean, I guess
Well, no, I
Walmart
mean,
buying all the product.
Walmart's marketplace isn't that big, so it's not subject to these laws, right? But you're not
Sure.
wrong, right? It is not different than Walmart, but it's more about how is it not different than Walmart, the physical retail store, or Walmart when Walmart sells its own, right?
Right.
Because, and let me tell you why, because you mentioned this whole idea of the controversy of Amazon competing against its own sellers,
Right.
right? And that was
Yeah.
that came up a lot in the antitrust context, right, during the hearings when Jeff Bezos spoke, and before that. But you know what Amazon's response to that was? I mean, it was
Yeah.
actually this is why the store theory is quite scary to us. Is that they pretty much admitted, they said, we're a store, and like any store, we're going to look at the data that's available to us and make decisions about offering private label. In other words, what they're telling Congress is, do you know what Kirkland, Kirkland,
Yeah.
Costco,
Right. Yeah.
stores, right?
Huge. Yeah.
Right. Do you think when Kirkland, sees how well the Tide, when they decide we're going to make Kirkland laundry detergent pods, do you think they might have looked at Tide's data? Like, oh, look how well these Tide pods are selling in our store.
I
Of
think
course they
so.
do.
Yeah. Right. Right.
Everybody, right? And that's when Amazon's point is like, wait a minute, no, 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 we didn't steal Amazon's data. We did the same thing that every retailer in the world does. We just took the data that was available to us and said, let's get into this market and let's be a store brand.
Yeah.
Now there are some differences because while placement in a store, in a physical retail store is a little different than kind of digital placement because you can really manipulate that. But Amazon's argument has been like, hey, all these things you're accusing us of, yeah, if we were an online platform, that does sound pretty bad. But guess what? We're now telling the world we're a store. And
Mhm.
you'll see it in all of their comments now. If you Google what Amazon's official statements have been, go read the antitrust reports, like Amazon's testimony, read their submissions that they wrote. They will consistently say, we're a store, we're a store, we're a store. And as you and I know, Paul, because we were helping our clients with sales tax issues
Yeah.
back in 2017, that was the exact opposite of what Amazon was saying for the
Right.
last 15 years. So
Yeah.
it's a clear, to me, it's a clear signaling of what their legal strategy and what may also be their business strategy in the future, is to make themselves more like a store and really kind of reimagine the third party marketplace into more of a third party consignment store where Amazon is the store and sellers who can sell can consign. But then you also have this mass consolidation through these big buyers that it's like so many
I,
different ways it could play out. It's just
yeah.
fascinating.
Well, let me ask you this. So, what type of businesses are these portfolio companies gobbling up? Is it everything under the sun or specific types?
So that's interesting. So they actually, for the longest time, originally they used to sort of, the unofficial mantra was we're brand agnostic. We're category agnostic. In other words, we
Oh,
don't care. We don't care really what you sell. If you're making money on Amazon, what they care more about is like where you're getting your money. For example, like if I have a client who's doing like 50% of their sales on Amazon and let's say 30 or 40% on their website, excuse me, and
yeah.
maybe another 10 or 20%, retail, wholesale, traditional, direct to the store, to the physical stores. That's not going to be attractive to some of these guys. Like they're not going to be interested in that. They really want their main focus historically has been we want 70-80% Amazon.
Oh, interesting.
That's all they care about because it goes back to that, I was sort of explaining before where it's like they put your brand through this, your Amazon listing, your brand through this sort of assembly line, and what comes out is 30% growth within a few months and 100% growth,
Yeah.
and they can do that with Amazon brands. I think there's an element of that that's changing. Like I think they're reimagining. Some of the bigger ones are reimagining. Like, hey, what could we do more direct to consumer? But historically, that's all they cared about. They were brand agnostic. But we are seeing some changes. We are seeing like, okay, now they are starting to be more strategic. They'll be, I've seen strategies such as like, they may acquire, a buyer might, let's say they acquire the number one, keto supplement on Amazon, right? Well, they may go and acquire the number two keto supplement. That may be an idea, right? Or they may decide, to look for complementary products. Like they just bought into this big, kitchen and bath company, or sorry, home and kitchen company, and they may go look for another home and kitchen company.
Right.
During the pandemic, home and kitchen was amazing. Like you did amazing if you were in home kitchen. We
Really?
called that
Oh, good.
the COVID. Yeah, we called that the COVID bump. Anything home, like anything you would find
Home,
at a
right.
Home Goods, if
Right.
that was your brand, you probably had the best year ever in 2020. But in
Yeah.
2021, like right now, like April, May, June, and into now,
Yeah.
nobody wants to be home. They all went out of the house. Everyone's leaving, right? So what we call this the COVID bump, where we saw like this huge spike in 2020, and then like 2021 sales are kind of look really lackluster. So actually, it's been
Fascinating.
interesting. We've seen less interest in the home and kitchen over the last few months. I think it's coming back as we get into the holidays. People are coming back from their summer vacations and they want to decorate. So I think
And the
it's
new
coming
strains,
alive.
Paul. And the new strains, Paul. We're all
And the
going to
new
go back
strain,
home.
exactly.
Right. Yeah. Yeah.
We got Delta, Echo, whatever, Bravo. We got all of it.
Whoa. Yeah.
So, you know, so yeah, so it's just kind of shows you like that. I think they are more selective. And again, the bigger buyers, they have these mandates that they have to spend the money that they're given, then they have to spend it fast, and so they also need to buy bigger. So
Right.
we're seeing less interest in, like you said, under 500, under 400, under 3. They keep raising what they'll even look at. Whereas again, a year ago, if you were doing 125,000 in profit, you probably have an easy time selling your brand.
It's
Now
amazing.
it's
Well,
yeah.
a little bit different now, but what are you like? What are you exactly doing when someone comes to you and they want to sell their business? What are you getting into with them?
So we're getting into the process, right? So we're like we're the Sherpa, right? We're not the broker. Some of our clients use brokers.
Uh-oh, you froze up there. Are you there?
Okay, I think it's
Oh, there you
back.
go. Yeah, you froze up for a second. Sorry. Go ahead.
So it's like we're like kind of the Sherpa in the deal. We're the deal Sherpa. So we're not a broker. I have mixed feelings about a broker, especially when you're charging 10%, 15%, and it's like, but there's, I can email 100 people and have a bidding war in a week.
Right.
Why do I
Yeah.
what do I really need to pay you 10% for that, right? I have mixed emotions. Some brokers do really great. Some brokers, some brokers are calling themselves the Goldman Sachs of bankers. It's like it's kind of nonsense. They're
Right.
kind of over stressing their importance. But let's forget whether we get a deal from a broker or from a seller, right? Who's come to us and they said that we were in the process of trying to sell our business. Usually it starts with a letter of intent, right? They come to us with a letter of intent. We review it's always non-binding. There's never any breakup fees. Usually it's just sort of an understanding. We're checking to make sure that we've got the right non-disclosures in place, that, to the extent we can protect our client from, the buyer potentially, acquiring some trade secrets about our client. And then,
Right.
maybe they own the competitor and they could use it. We want to protect against that as much as we can. And then there's a very quick due diligence. These deals close quick. They close 30, 45 days.
They
And I
do.
will tell you, yeah, they close real fast. And it's unlike anything I've ever seen. Like, as back in corporate, deals could take years. It's like, it's
Yep.
not that. These deals close really, really fast. And so due diligence is actually not very, very good. Like I've noticed very few of these buyers do a great job with due diligence. There's a few that do. But I'm a little concerned about those that don't. And the reason I know that is because of things that we've, disclosed, that we've, like for example, like we've uploaded it to the, clients uploaded to the data room. Then we get to the contract. You have to put these disclosures in the contract, in addition to what you're
Yeah.
disclosing due diligence. And they're looking at it for the first time. They're saying, why didn't you tell us this before? And I'm like, well, we did. Two, it's also public record because it's, let's say it's on the USPTO trademark website.
Yeah. They
So
should
who would
know.
have
They
thought?
should know
They should
already.
have
Yeah.
looked. Yeah, I mean,
Yeah.
like, did you look? And it's like it's a little concerning to us. Like, did you even look? Like but they're just going through it. But the due diligence factor is a little scary there. But the reason they do that is then you get a contract, right? So you go through this due diligence process where you just upload. They upload a bunch of stuff. It's very fast. They're just basically making sure that it's very easy to prove out the earnings because they pull your sales data right from Amazon, right?
Right.
The only variable they have to solve for is what your cost of goods are. Like, what are you paying your suppliers? Which they can do two ways. One, they'll look at what your data shows, but they have their own sourcing agent, so they can figure out if we didn't use this person's sourcing, what would it cost us elsewhere? So they have different ways to figure out solving for that X. But once you solve for that, All the other data comes from Amazon. So from in terms of like the reliability of the sales data and the numbers, it couldn't be better because it comes from an infallible source, right? It comes
Right.
direct from
Right.
Amazon's data feed. They're going to
Right.
pull right out of Amazon. They're not going to. It's not the seller's not going to give them a report. They're going to pull it themselves directly from Amazon. Um, so that's why due diligence can be fast in other ways. And then you get to the purchase agreement, and yeah, it's a little scary, Paul, because one, they want you to be personally liable. Like it's not your corporation that's going to sell, right? This is
Right.
where you guys come in, right?
Right.
They want you to be personally liable. Their concern is if your LLC sells us the brand, you take the money out of the LLC and you run off to Cayman, wherever, somewhere nice, right? You run off to Bermuda, right? All they have left to go on if they need to sue you, if you lie to them, if they have a claim against you that you're supposed to know, all you left them with is a shell company. So they rarely will ever. We've been fortunate a few times to be able to do it, but they expect you to sign personally because they want to be able to go after you personally in the event that your company is a shell company. So that's a big deal.
Yeah, because
And
you and I mean, we've worked, together, our firm and the asset protection side with you doing
yeah,
your stuff. And that's true in these M&A deals. I mean, there are occasions where the buyer comes back and if your butt's on the line, you got to have asset protection to just make it a clean transaction.
yeah, and the scary thing about, and I'll tell you something even scarier that I don't think people realize, but this is my pushback, this is all negotiated, but
Yeah.
let me tell you something a little scarier about being personally liable in a deal like that. If you're a lawyer, if you don't know what you're doing, right, and you're not thinking asset protection, when you get sued, right? Let's say one of your customers hurt, they take your product, they get really sick, and they sue you.
A supplement. They take your
Supplement, right?
supplement, they
Take
get
your
sick.
supplement, they get really sick, and they sue the buyer, right? Or they sue you, right? Let's say they sue you, right? If you have, a well-structured Barth Calderon asset protection program, right, with good LLCs, everything in place, right? You're definitely. We can't use. I'm a lawyer. I can't say the word sitting pretty, but you're definitely better off, right, than having not. Right, you have a
Right.
nice structure set up. You're asset protected, okay. But what happens if that buyer sues? If that injured party sues the buyer, and you're indemnifying the buyer personally
Right.
for up to no limit?
Right.
Now
You're
there's no LLC anymore. It's just you indemnifying them for the full boat. You have no asset protection. You've lost the benefit of a basic LLC at that point. So you better negotiate. So we obviously have to negotiate, what we call, caps. We have to indemnity caps. We obviously identify certain things as being more fundamental than others, certain risks. But that's what we do. That's my job. It's my job I tell my client, like, you negotiate the price. It's my job to negotiate the risk. And if
yeah,
I can't
yeah. And I
negotiate the risk, I have to explain it to you. What I
right,
can't
yeah.
negotiate away, you got to understand that, and then you make a decision because I'm
Yeah.
not your deal killer. But one of the smartest things they can do is go talk to you guys on, okay, I'm personally signing for this. There's no way the buyer's going to let me not sign for this. What else could I do to cover myself? Excuse me.
Well, you were
It's an
talking about a
important
donkey. You
question.
were talking about a donkey when you said ass. You were
Yeah,
talking about a
actually,
donkey.
yeah.
Yeah,
How do I
yeah,
cover my donkey? Uh, so that if this comes back on me, if the buyer has a claim against me, if the buyer's accusing me of something or saying that didn't pan out the way the buyer wanted it, and he's going to try to put some claims on me, or
yeah,
somebody sued the buyer because my corporation disappeared and they're trying to relate it back, successor liability. How do I do so? Yeah, I mean, this is where asset protection really comes into play, and play a big part. It's a smart move because you're going to have, yeah, you're if you're holding on to millions of dollars that they just paid you, and depending on depending on the buyer's risk tolerance, depending on how well your lawyer negotiates, I've seen scenarios where it's like it could be 5-6 years. I had one deal where they were trying to insist on like the full statute of limitations in Delaware allowable, which is actually 20 years. If you didn't know this, which is scary, it's actually 20 years, right? Delaware
mhm,
can allows parties to privately negotiate statute of limitation, basically up to 20 years for these types of things. So like, it could have been, if that's a scary thing. So like,
right.
do you want to be looking over your shoulder for 5, 10, 20 years, wondering if like, okay, all this money I just got, they're going to try to claw it back and take my house away, right? So asset protection actually is really important for a lot of our clients when they close and when they get paid.
Yeah,
because
well, because you've worked with our attorneys at the firm, and they talk a lot about you do a deal like that, all of a sudden there's a huge liquidity event. That's where that stocks, bonds, and cash, people are investing it, or they have big cash positions. You're talking about stocks, bonds, and cash LLCs and protections for, if you're buying rental property and so forth. But yeah, you cannot leave it out there naked.
and I'll tell you one more thing. I'll tell you something interesting. 'Cause you made a really good point. It's like, uh, it's just it's a lot of times, our clients are interesting. Some of our clients are, some of our clients are kind of a little young, maybe not. So maybe they're just a little carefree. Like
Right.
certainly a lot of 20-year-old millionaires. Like a 20
Absolutely. Yeah.
22. And maybe just full of that vinegar, and nothing can go wrong.
Right.
And they don't think about things like this, right? They're too young, right? They're not thinking about estate planning. They're not thinking about asset protection planning. And like they'll say to me, they say, but why would this very famous aggregator buyer, right, who's trying to get all the Amazon sellers possible, why would they ever sue me? It would look ridiculous. Nobody would ever want to sell to them. Their reputation would be destroyed. And I said, but you're not thinking about this right. I said, you're assuming everything's going to work out well. I said, if that aggregator, that buyer fails, if it falls apart, it's not that buyer suing you, right? It's the creditors, right? It's the
Right.
people who lent the money, who invested, who whatever, right? Or it's a bankruptcy trustee who's going to look through every one of these contracts with a fine-tooth comb and find every possible claim he can to claw back whatever. Right? You just have the imagination. So the asset protection really is,
It's a good point.
it's really essential. And then the other element of these deals obviously is, we try to negotiate as much cash at close as we can. We want as much cash for selling clients, but there are these things called earnouts. Sometimes they're notes, right, where you get the
Right.
opportunity to earn money over the course of the next year, 2 years, 3 years, depending on the performance of the business, right? That's always the first place they're going to go to cut, if there's problems.
Right.
But I always tell my clients those things, but those earnouts, I've had a client come to me and say, look, I got this record breaking multiple of 7x. Have you ever seen anyone get a 7x? I said, but it's 50% cash and
Right. Right.
50% earnout. And unless this company goes, 500% in the next 2 years, you're probably not going to get most of that. So it's really a 3.5x, and you're being fooled. And so what I always tell my clients is, when you make a deal for your brand, make a deal for the cash at close, and
Right.
treat the earnout, anything that is deferred, anything that comes to you later in life, right? That's gravy. That's bonus.
Yeah.
And
It's
if
almost like
you're
it's almost like an NFL football contract, right? When they sign those, it's like, I'll get the money up front because injury is going to happen down the road.
and
Injury. Yeah. Yeah. Yeah.
and you can be right. So that's why I say, like, if you I always say, I'm like, looking at this deal, if all you get is the cash at close and you don't get that earnout, are you going to jump off the Brooklyn Bridge?
Right.
I'm like, because if the answer to that question is yes, this is not the deal for you.
Right.
Because what they don't understand, it's like if your earnout's a million, if you're doing $100 million deal and you've got a $20 million earnout, you might be in a situation to litigate. But if you're doing a 2 million, $3 million deal and your earnout's like 300, 400, 500 grand, like litigating an M&A deal is probably one of the most expensive things you'll ever. I mean,
Right.
you'll
Right. Right.
risk that amount trying to litigate, and if you lose, you got to pay their legal fees, which will be very high. So in other words, what I say is, like, no matter how well I write it, no matter how well we negotiate the terms, like, all your leverage is gone once you get paid that closing cash. Once that closing
Right.
cash hits and they own you everything and they're running in the show, you lose all your leverage. They don't want to pay you. They don't have to sue you. They just don't pay you. And then you have to sue them. And that's just how easy it is. And
Yeah.
so that's what we always tell our clients. That's how, so focus on that closing cash, leave the deferred. And then, like I said, take that closing cash, get some asset protection advice is the next thing. Cause you may have put your name on it personally. It just is what it is,
Right.
these days.
Yeah, Paul, this is awesome information. We're hitting up against a ceiling here time-wise, but man, you and I got to further this discussion and get some more of these, these sessions going because I think our audience really benefits from this. I want to thank everybody for listening with Paul. Awesome. Thanks so
Thank
much.
you.
Yeah,
Always good to catch up. It's really awesome. Thank you so much.
yeah, yeah.
Take
We'll
care.
talk soon.